So today on the show, we have Matt Henderson, and he's from VREC, which is a syndication based out of the Midwest. It was interesting to hear him and Ken talk about what they look for in different investments in today's environment. Enjoy. So Matt, let's discuss interest rates right away, since the Fed meets here in about a week, to kind of see what your take is on what's going to happen with interest rates and all the different things that are going on.
I think I'm in the same vein as Kenny when it comes to it. I think there's going to be a move, but I don't think it's going to be as impactful as people might hope. When you're in the commercial space, 25 bips is great if you can get it, but it's not going to save a deal that's being lost, and it's not going to get anybody out of any trouble if they're in trouble currently. A lot of those, survive the 25 guys are, we're actually borrowing from those guys right now.
I think a lot of people hang on these quarter point, half point things. And while they might be meaningful with somebody's monthly payment and they're trying to buy a home and stuff, on the commercial side of the equation, it doesn't really move the needle that much, right, Matt?
Oh, definitely. If you're talking 25 bips on a $15 million loan, you're talking about 40 grand a year in debt service that you save.
Right.
That's not. We're buying from a group right now that's losing $35,000 a month in operations, right? So that, and they're not in terrible shape. There's groups that are in much worse situations than that, but they're losing 35 grand a month. So saying, hey, I'm going to save you 40 grand on my debt service for the year doesn't really move.
Right. So imagine that you're losing 35 G's a month and you're going to get relief of 3,000 or 4,000 a month. It just doesn't move the needle that much. And I think that's the point.
But I think it's a bigger issue here, or a bigger subject, because, Trump, he can't just do anything just normally and easily. So he is now, putting charges against Lisa Cook and trying to get her off the board. We also know he gets to elect his own Fed chair in May. So I think that because of this, though, that it won't just be 25 points. I think over time, like over the next 6 or maybe 12 months, we can be looking at major interest rate corrections. And do you think that would move the needle on multifamily?
Yeah, of course. I mean, anything that trends down that way, I'd love to hear Matt, but it's going to take 6 months to a year for this to really get back to the way it was. And so, it's death of 1,000 cuts, right? Like, so the people that are in trouble are the ones that are really needing it. These are pretty decent rates today. You should be able to, we could cash flow today. I don't know. We bought a lot this year, Matt. You guys are buying a lot, at today's rates, right? So you got to buy on today's rates.
But I do think, though, that the multifamily market is very different than the single family market, because, you guys are saying people are in trouble in the multifamily space and you're buying from them, the people that overpaid. And you're right. At today's rates, multifamily is cash flowing if you have the cash to buy a deal. But I think single family people get a little confused because everybody is in a locked, really low interest rate. Those sellers are not in trouble. So it makes the single family market very different from the commercial space right now.
The multifamily is in the exact same scenario.
Yeah, I agree. I was going to say the same thing. I think in the multifamily space right now, the guys who are in trouble are still the outlier. They're not the norm, right? We're not seeing systemic risk. If I want to go broad, I guess. For what we're seeing is that there are some people who got over their skis. Some cases they're doing excellent in some deals, and some deals they're doing terrible, right? It doesn't mean it's all or nothing, right? So there's some guys that are cutting their losses on deals that they basically got over their skis on. But overall, the overall market is ridiculously stable, relatively speaking. When we got in the game in 2008, we kind of jumped in at the bottom, right? We didn't realize it was the bottom yet, but 2009, 2010, we got in the game then where you couldn't get financing for multifamily. It was literally not an option. Like, we couldn't talk to any bank that wanted to do a multifamily loan. So we were literally starting off buying deals cash, right? All cash was the way to acquire properties for that little window of time. And even here in the Midwest, which is a different, more historically stable market, we had an increase in vacancy. Our vacancy went up for a very short period of time, went up to 80. We were at 89% occupancy, 90% occupancy over the market. And kind of what we learned there, I guess, or learned from that time period was, and that only lasted for 6 months. And what it really was a shifting of people who had lost their jobs, having to find somewhere else to go. And there was just a shifting. right? Where it's like, hey, you might have been in A, now you're in B, right? You might have been in B and now C makes sense for your budget, right? There was a shifting that happened here, but we dipped down to 89% occupancy, and within 6 months we were right back up at 94, and then it just kept going up. Kept going up to the right for years to go. I think this does not reflect that. This is not that type of environment. If you understand what I'm saying, there's not that level of, I can get a loan on anything right now. Right. We've got the track record. I can get a loan in a heartbeat on, we're pursuing 1,000. We got 1,000 units in our pipeline right now, right? That we're acquiring.
It's super exciting what you guys are doing. But Danille, I think we should get into some of the basic math. So look, what I mean is if you add up all the operating expenses of like a 200 unit apartment building, add them all up, and then you add the mortgage payment on top of that, you really should only have to collect, in the let's call it the low 70% range for it to break even. In other words, you can be at 75 or 80% occupancy and still cash flow. That's kind of the point. You don't want to be, but that's called the break even. So whenever you're looking at whether people are, paying investors or actually funding it themselves, it has to do with just those two things. What are your operating expenses plus your mortgage payment? And what's really changed is the mortgage payment went up a lot because people had floating rate debt. So their mortgage payment went up. So their operating expenses probably went up a little bit, but what really went up was their mortgage payment. So they don't have enough income to actually cover those two things. So a well-purchased property has stable expenses and a stable mortgage payment. And your break even should be around 70% collected. And I know that's low, but that's about where we are. So we would literally have to, our occupancies of our properties would have to drop into the 60s for us to be funding them. So when we're in the 70s, we're actually making money. When we're in the 80s, we're making money. When we're in the 90s, we're making money. So what's happened is a big variable is that mortgage payment.
But also people overshot on rents, right? Because you're saying if you're in the 70s, you're breaking even, but not if your pro forma said that your rents were going to be 20% higher than they are coming out to be.
But that's just an experience. Like, nobody would project those kinds of rent growth. I don't know, Matt. I mean, we do 0 to 3% a year, right? Isn't that about what you guys do?
Yeah, we're in the same space. We're in the same space. So, and then obviously people look at deals that they're buying. Some of these deals had, there were areas that had astronomical rent growth, right? But the mistake that a lot of guys were making was assuming that would continue, as if that's it only goes up and right. Those guys are learning, and it's a hard lesson. And unfortunately, in a lot of cases, the investors are the ones who actually are paying the price for it. They're losing their reputation, but their investors are losing their savings. So, we've talked about this many times together, man. But we really literally were looking at these guys like, how are they buying? What are we missing? Like, we're starting to question ourselves. Like, are we missing something here? Over the years, and as it kept going up and to the right, it worked. It worked at that time frame when it was 6% annualized rent increases for a little bit there. That worked. But if you got caught, now you're getting caught.
We've never, ever underwritten expenses more than 3% growth, ever.
Right.
So, right, that's like, for us, that'd be the ceiling. Like, I would never do that. Now, if I got 4, 5, 6, 7, 8%, that would be a gift, but you would never, ever underwrite it that way.
So let's discuss how you guys look at markets, because you both invest in very different markets traditionally, where Ken, your markets are more cyclical, and Matt, yours is more of a steady market, no major ups, no major downs. So there has to be different ways of looking at that in the Midwest versus Ken, where we invest like on the West Coast, Texas, etc.
Yeah, man, I'll let you start. The Midwest has been kind of the sleeper, but in a good way for you guys. You guys were, gosh, you've been buying stuff there since after the GFC, and just crushed it. Right now, everybody's kind of looking at the Midwest, right?
Yeah. I guess the secret's out a little bit. I think the way I think of it is it's like if you're dating somebody, and they're hot and they're crazy, right? And after that breakup, after your wallet's emptied and you're walking away from that situation, you're looking for that stable Midwestern girl. You know what I'm saying? Like,
Oh man, like look at this.
I'm just saying, if you've had a situation, I'm not, whatever. So the point of it is that's the way I think of the markets. It really is like, you know, some of these markets, Austin is hot and sexy, or was about 4 years ago, right? About 4 years ago, it was the place to be. If you don't own in Austin, what are you doing in multifamily, right? What are you doing in real estate? And it was exciting, and people got some great returns if you were able to get in and out quickly enough before the falling knife started to happen. But at the end of the day, when you're looking at our markets, they're just reliable markets, right? Where I almost think I really come to the opinion, especially getting to know you better, Ken. I've come to the opinion that it's not that the market's the problem. It really is just the operator. It's always an operator thing, right? It's always does. I don't care if you're in Timbuktu or the south side of Haiti or whatever. Pick anywhere on the planet. It's the operator that determines the success of the property. And I feel like you would be obviously you would be just as successful in the Midwest as you are in Phoenix, because you would make the adjustments necessary to underwrite properly and conservatively and protect your investment.
So I do have a question though. You said that there's things that Ken would look at differently if he was investing in the Midwest. So what are those things?
Well, I don't know if he would. It's still the same things. It's just the metrics change a little bit, right? So we're still looking at the same things. We're looking at job growth. We're looking at population trends. We want to see a diverse employment space, not just job growth, but also a diverse employment base. You don't want to be one sector dependent. So that's one of the reasons that we specifically don't invest around military bases unless there's other industries around it, for example, right? If they move the base, the whole place goes away. If GM closes the plant, that kind of thing. You want to look for a diverse employment background. We're looking at good schools. I mean, it's the same. It is the same things. I don't think there's any trick to looking at these two different types of markets. I think understanding where you are in the cycle is way more important in those cyclical markets. Simple as that. You just need to understand the cycles. And if you've had the experience of been around, or you've got a friend like Kim McElroy that you can call to help you walk you through that, it's a really good boon. But at the end of the day, it's the same thing.
Typically what you find is, it's a lot of times we've spent our time up at 30,000 feet looking at all the macro stuff, and it's important, don't get me wrong. But at the end of the day, what kind of renter do you want? Is it student? Is it senior? Is it low income? Is it high income? Is it, bread and butter, middle of the road? So that you have to consider those things. And what do those people want? What they want really, what does everyone want? They want a safe, well-maintained place, safe meaning, low crime. They want great schools. They want to raise their kids without a lot of drama. And that's where we want to buy. So you start there, and then you start to back away from what I would call the non-negotiables, right? So I'll give you an example. We had some high-profile bad landlords in Phoenix, and the mayor. I talked to the mayor, and it was a political move on his part, because he was like, I'm shutting these guys down, blah blah blah. And he was getting all these kudos. But I went and met with him, and I said, hey, I'll buy all those. I'll take them off your hands, and I'll fix your problem, and I'll make it your issue. And so I went and looked at these properties. Well, they were horribly managed. So he was right, but they were in horrible neighborhoods. And I was like, I went back to him and I said, hey, Phil, like these, I can't buy these. The neighborhood is worse than the property. And so, so even though you might find great deals, poorly managed, and, with massive upside, when you have those kind of external influences, they spill over into the management. No matter how good of a job you're doing, you can't build a moat around a property that, has systemic neighborhood problems. So it's actually quite simple, quite basic. Where do really good people want their kids to go to school? Can they walk home? Can they hang out outside? Can they go walk their dog at night? Is it safe? Is the property well maintained? All those are the basic things. And if it doesn't pass that, then you just pass, right?
Yeah. Yeah. And I'll throw out there real quick too. I similar verbiage. We also self-manage, with our company as well. So we've always managed our own assets. And being in that space, understanding that the actual guts of how the business works is crucial. I would say, I say to our staff all the time, would you live there? So it's the same premise. It's the same premise as you're saying. Would you be comfortable taking Danille on a date there, for date night? But it's the same thing. Would you live there yourself? Right. And if you won't live there, then either we're not doing a good enough job, man. If it's our asset, then you're not doing a good enough job management. We're not done with our improvements, or it's a pass. Right. So creating an environment where you feel your staff would feel comfortable. Another draw, and we've dealt with rough stuff like that. We've cut our teeth on some really rough stuff and rough neighborhoods, and we did exceptional in turning those places around, right, and making an impact for that particular little pocket, right, that we're holding. But at the end of the day, it's harder to staff it because the high quality staff that you want they don't want to worry about their safety even if the property's safe, even if you gated it and made the property safe. They've got to get out of there and go to where they actually live, right, every night, right? So you'll have higher turnover. It's harder to attract talent if you're saying, hey, part of your uniform is this flak jacket. You're gonna have to wear this at all times while you're there. So just throwing that out there.
Yeah, well, it's really a good point. Like, think about also the other systemic problems with buying a property like that. One, you have credit problems a lot of times that follow with that. So you have higher turnover, both with the residents and with the staff. Yep. And to Matt's point, it's, it takes a very significant kind of a person to go manage a property in a high crime area. Yep. They have to have an extremely thick skin. I had a guy that used to, by the way, he was a nut job, and I love this guy, but he was an ex-military, and he used to throw a 1911 on his hip and a gun, and go walk around and collect rent with it. And I'm like, dude, please don't ever use that. Now we're in an open carry state, so you can do that. But the point is, it takes you got to have a couple screws loose to be able to manage and collect rent and also all the other stuff. Can you imagine all the other
delinquency is higher, but because if you're dealing with the populace that's paycheck to paycheck, anything goes wrong and the rent's going to be late, right? They're walking a tightrope, and a lot of people are in that space in our country. I think people overlook that.
And they're out of and so what they do is they just move. They skip in the middle of the night because they have to financially, and it's embarrassing for them, and it's no fun. So the point is, it's harder to manage cash flow. Yes, you might be able to find a great deal, but right. Then people minimize the amount of work that it takes to squeeze that juice out of that orange. It gets harder and harder with in rough areas.
I'm gonna tell you too. I'll be full disclosure. We're actually buying a project like this right now in a good old Cincinnati, Ohio, right where I'm sitting. Right, we're buying a project like this right now, and I'm gonna be calling you for an investment.
Yeah.
Just telling you. But the point that we're actually buying this project, and the reason we're buying it, I'll explain a little bit. The reason we're buying this particular asset, this portfolio, it's 3 properties. We were reached out to by the city solicitor and the city of Cincinnati. And we have a track record of turning these type of properties around, right? So they reached out to us. The conditions are terrible. It's been run into the ground. The guy leveraged it all the way to the hilt, 90% leverage kind of thing. We are actually acquiring it, and we're going to turn it around and stabilize it. Where it's positioned, it's not the worst of the worst neighborhoods by any means. It's not like, Beirut or something like that in the 90s or whatever. But it is a rougher product that we've been looking at recently. And it was one of those situations where we're actually getting it for less than the debt. It's basically a short sale. The lender had to approve the purchase agreement. We're buying it at 2015 prices. It sold for slightly more than what we're buying it for in 2015. So that entices
Yep.
enough. And the fact that it's down the street from our office,
Yep. Yeah. So, yeah. And depending on, if it's on the fringe and you have a plan and again, not all is bad, but Danille's question was a good one. How do you make those kinds of decisions? And, if you buy it at 2015 numbers and the city's motivated to help you get through it might be worth it.
So Matt, we obviously know what the risks are to a cyclical market because it can go up and down, but a Midwest market that it doesn't really cycle and it's pretty steady. What are the risks there?
I guess it really depends on your investment thesis. It's obviously less risky, less moving parts, so to speak. If it's not a cyclical market, you don't have to necessarily time the market as much. Though there are still cycles in these markets as well. We're still affected just by the macro, like everybody else. But that being said, one of the risks you would have to consider is the exit. If you're looking at a steady cash flowing asset and you're thinking, hey, I'm going to do a 2, 3 year, 5-year hold, and I'm underwriting to a significant exit or cap rate compression or anything like that, if that's part of your business plan, then you're at risk. You're putting yourself at risk with your underwriting. There's a potential. What we're seeing is trends that rent growth is consistent, steady, not explosive, and that will continue to go along, but which works for a long-term hold. Like if you're going to play the game for, you're okay holding a property for 10 years. If you're okay for holding for 20 years, even better, right? That will work out for you. But if your game plan is I'm in and out in 3 years, that's risky. That's risky. Well, in my opinion, that's risky in any market.
Yeah, I think it's it's interesting when you start to look at markets. There's linear markets that just kind of go up a long way. So I think a lot of ways Tucson could be considered that, right? Now, but here's the thing about something like Tucson versus Phoenix as an example. If you add 1,000 units to Tucson, it can disrupt the market, right? And I think that's an important thing to say. Whereas if you add 1,000 units to Phoenix, no one will even know. And you add 10,000 units to Phoenix, really, truly, no one would even know. And some of it is, of course, where. And most prudent developers are putting new units, for example, in the path of growth or the path of progress. And so sometimes you do have these temporary, these cyclical moments. But I think over the long trend, you're typically in pretty good shape. So, and also let's don't forget about Matt's philosophy and Stephen Robbie's, his business partners are very similar to ours, where we're not thinking of things in 3-year chunks or 4-year chunks or 5-year chunks. Our investors are looking for long-term cash flow with tax advantages from bonus depreciation, cost segregations, regular depreciation, tax-free cash flow, cash out refi, which is also tax-free. That's what our investors want. And so we're not flipping 200-300 unit projects, and trying to time markets. So it might be that we buy something and it goes down, and we just have to manage the heck out of it to try to, maintain. But over the long haul, the tenants pay it down, and we kind of get there over time with good, sound, prudent management. So, but to your point, Danille, a cyclical market is something that, has risk with a lot of new construction or new supply, let's say, or maybe one big employer that moves, right? Or like a military base, or, maybe a big employer that, moves to another area for in the country, or even in that area, all of a sudden you have these kind of job losses. And those are kind of the things that you look for.
So if you're both looking at investors now, what's the number one risk you think investors are underestimating currently?
In my mind, I think there's a disruption coming. We're underwriting to higher vacancy than historically normal, and then what the market is currently displaying as well right now. Once again, what we saw in 2009 and 2010, man, that disruption, it might be just, you lost a job and you find another one. Or it might be you lost a job, and in this space with AI being so prevalent, and we're seeing these layoffs happening across the country, you might lose a job and not find another. You might have to find a whole new industry. You might, I don't know. I mean, I don't want to go into UBI. We can start talking. We can really get into if you want to. Depends on how deep you guys want to go today. But there is some major disruption coming. And I think people are underestimating it. I think if you're doing anything that's not fixed rate right now, I don't care what the rate is. If you're not fixing it right now, you're bananas. Because though the rate risk going up, I think rates are going to probably come down. They're probably going to come down. And that's not a prediction. This is just my humble opinion. I think rates are going to come down. But if that's any part of your calculus, you are bananas. Like, you should don't bet on anything other than something that's going to work in the worst, most adverse circumstances right now.
Yeah, I think there's a couple things. I think that what investors are seeing are the mistakes that they made on picking the jockey, like the operator or the syndicator or the owner. So like Matt and Steve and Robbie, they've been in the business for 16, 17 years now. And so they've seen ups, they've seen downs, they've made mistakes, they've slowly built their team, they've slowly built their base of units. They've made great relationships with vendors and all those kinds of things. That's what investors should invest in. And we have the same thing going on with us. Where most of the people have gotten burned is by moving away from what that very, very, very basic philosophy is. Like, who's actually managing your money? And as these markets change, as the things that Matt said, the experience and the syndicators that are a little more wise and have been through cycles, they're making better decisions on the way they're managing. They're making better decisions on the way they're buying. They have better relationships with the lenders, with the vendors, with their employees. Everything's more stable. So so that's what's getting exposed now. And that's why Matt's getting the call from, the officials in Cincinnati, as an example. They're calling him. I mean, think about that. Like, let's don't discount how big of a thing that is when somebody at the city is calling his company and saying, "Can you help fix this problem from somebody else?" That's a big deal, and that's what investors need to be looking at, or those little things. And we don't always pat ourselves on the back for all of this stuff that we've done, but the investors that have lost money in a lot of cases, or are losing money, aren't being communicated to, and all that stuff. It's because they picked the wrong jockey.
So, Matt, you're investing in mobile home parks, and this is kind of a new direction for your company. So I wanted to ask why you guys are heading that direction, and what are you seeing that makes this enticing to you?
A couple of different things, honestly. This is a sector that we kind of looked at from a distance and kind of said, hey, that seems interesting, but we're busy as crap right now with our own thing, the multifamily space. This kind of got just basically landed on our desk. It was presented by a local guy who was something of a bird dog. He brought this deal. It's got some really unique characteristics to it that made it worth venturing out of our box a little bit. And basically, it's a great location, great school district, completely undermanaged. This land's been in the same family for over 100 years. The mobile home park was started during the Great Depression. Right. So, I mean, and honestly, I don't know if they've done any renovations since the Great Depression. But for us, the price point that we're getting it at, it actually appraised with $2 million worth of equity at closing. So we're going to close with $2 million in equity. The rents are below market. I mean, it's got all the hallmarks of a classic value add, right? Except we don't own any of the trailers or the mobile homes. We don't own any of those. So we don't have the complexity that you would have in taking down a 300 unit apartment complex, right? We're really, for the most part, our role here is going to be to maintain the grounds, maintain the amenities, enforce community rules, and lease out vacant lots, which are in very, very high demand. So every single lot that this particular asset has that is functional is leased. So their functional occupancy is 100%, but then they have 30% vacancy because they have not maintained the other lots. So every time they fix one, they lease one. So that was a strong indicator for us.
So what do you mean not functional? Like how can a lot not be functional?
Well, just having, for example, now new lots are now getting 200 amp service, right? Because everybody's got more doodads, right, or whatever going on in their homes. So some of these have no panel at all, and they've just been abandoned. Literally, just people moved out or died or whatever, and the trailer's just sitting there, and they never removed it, right? So they've got abandoned trailers sitting on some of these lots. So that's what I mean by not functional. Like we might have to we're going to actually tear out some of these, remove them, and we're working with a national home manufactured home builder to set up a sales center on site where their sales team is going to sell for us. They're setting up a demo unit and everything like that. Now, the reason that we're interested, this particular asset was very appealing, and the returns on it are as well. But the reason we're interested in this space more is because this, a Class A mobile home community or manufactured housing community is really the next step from apartments where you can accomplish. I can have a 3-bedroom, 2-bath. And in the area, for example, the rent for a 3-bedroom, 2-bath in the area is $2,700 to $2,700. You can own your own manufactured home, 3-bedroom, 2-bath, same school district. Your kids are going to the same school and all that good stuff. And you're all in at $1,800, right? So that almost at the top of that range, you're at $900 a month delta. And that means something. That moves the needle for a lot of people. At the end of the day, that's that's a couple car payments. That's that's whether we're going to be able to go on a vacation or not, kind of thing. So that we feel like that's the direction there's going to be more and more demand for this as the inflation keeps running. We just feel like that's the way to go.
Yeah. By the way, I completely agree with everything Matt said. I think a lot of times people, they watch TV or they have a stigma around mobile home parks, right? But specifically, there are some horrible mobile home parks in this country, and there are some horrible apartments, and there are some horrible single family houses.
Absolutely.
But there are also extremely well-run, well-located mobile home parks as well. And in fact, we've got some in Scottsdale that for a senior, well, they're like, there's a waiting list. So you gotta take your bias out of your brain when you're looking at a real estate class and take a look at all the things like Matt was talking about location and schools and all of those things. And then it starts to work and sounds like the math works. So, it's a prudent investment.
Yeah, Matt, how do you manage affordability on something like that? Because obviously these people are definitely on a budget, but yet also push your investor returns.
Yeah, for us, it's that's always been something that you've got to be aware of. You got to be cognizant of it. We're managing people's homes. We're not managing some doodad manufacturing company, right? So we do think about that, and it's part of our business plan, right? So we're buying deals with enough margin. We're actually what we've got in our current projections and our pro forma is that we won't bring the 190 occupied units will not be brought all the way to market for the next 6 to 7 years. So we're going to very slowly catch up on that delta. There's going to be an initial raise, in the first year of ownership, and then it's going to be they might, like hypothetically, let's say the rent growth is 2%. Think of it as they're going to be at 6%, right? Mm-hmm. As we get them closer. But we're talking about lot rents that are, $400 that need to be $800 to $900, right? So we're not trying to do that day one. And the business plan does not require it. We're not buying a project where if we don't jack everybody's rent out day one, this thing doesn't work. That's not what we're buying. We're buying a project that if that rent growth or attrition goes faster, it just gets better and better and better. Right.
And that's
3x deal.
One really important reason that he's able to do that is because it's not a short-term view. It's a long-term investment
Right.
with a good plan over a period of time that's going to cash flow for who's ever invested in it. And I think that is a big difference with what we just came out of, were these syndicators raising money and trying to get in and out, in just a few years. And the returns look really, really good, on a call it the big flip or whatever their plan was. Big value add that you're going to cash out and make some. It's really no different than a flip of a multi-family house. It just takes longer. But this is a long-term plan, and that's why you can do it. And by the way, they might be wrong, right? Like, it's very possible that rents go flat and things stay flat, but it cash flows today, so it doesn't matter. So maybe it takes 8 years, 9 years, or maybe they do it in 3. But the point is it works today.
Right.
Right.
And you're big on that. You're big on buying things that work now.
It has to work today. And then you have to have a plan. But, as we all know, like what's really gonna, what's this world gonna look like in 6 or 7 years? We don't know.
So speaking of that, that's a good segue into what I wanted to ask is, when you're both investing, do you worry more about inflation eroding your returns, like property taxes, insurance, rates, or do you worry about deflation pushing down values of certain asset classes?
Ooh, Matt, you go
There
first.
you go. I go. All right. So my focus is on inflation. I think, but I'm not worried about inflation, right? One of the reasons that I'm excited about the asset class and the business that we built is that we invest in inflation hedges, right? We literally put our money into things that ride along with inflation and are, for the most part, unperturbed by it. Now, what does happen is, obviously there is a breaking point for your tenant base where they're getting squeezed from every direction. Rents just can't go up. We've got a project we bought 7 years ago, for example, and it's in a C plus area of town. It's not bad, not terrible, not great, but it's a good area. And we've got a unique offering there where it's mostly townhomes. It's actually 100% townhomes. I'm sorry. We were just having a meeting on this one last week, and we were looking at it. We're starting to watch the delinquency tick up a little bit for this property, which we've had it for 7 years. We know the property well. We know how that should perform, and we're starting to see that number tick up. We're starting to see more roommates pop up, so we're paying attention to the roommate thing. And these are all indicators of pressure, right? This is pressure on that wallet, and we all know that incomes aren't growing as fast as inflation is running. And I don't know if you believe in, I think what did Jason call it, the CPI?
Yeah.
Instead of the CPI index for inflation. So at the end of the day, we actually froze rents there. Now the demand is still there, right? It's absolutely still there. If you just go from what the market is, what'll happen is you'll have more attrition than normal. You have more turnover than normal, but you can lease the units at a higher rate to somebody else, right? We're going to control that turnover and it offset, it'll offset the fact that the rents could be higher anyway, because we're controlling that turnover. But in addition, on this particular investment, all of our investors have been made whole. We've already refinanced them to 130% of their investment. It's cash flowing in the double digits based on the original investment. So by buying the deal right, we don't have that pressure where we need to just squeeze the life out of the tenant base.
Yeah, and I would just say, so in order to have deflation, there's a lot of things that have to happen, right? It's very hard. You can have deflationary times, for real estate, like we saw it in 2008, right? That is technically deflation. But I think the bigger thing, though, to watch at the same time. So George Gammon said to me once something that to me really stuck, which was, you can have inflation and deflation at the same time. So sometimes people think that it's either one or the other. He said, but if you think about the economy, inflation would be like a hot air balloon going up, and deflation might be a hole in the side of it. So you can have things that are going down, like tech, like most electronics or things like an iPhone or whatever, you're a car, a brand new car, we know those things are deflationary. There are other things that are inflationary, right? And so anyway, but to answer your question specifically, I think if you're buying if you have $1 million home and the inflation rate is 3, just by simple math. I think you would rather have a 3% inflation rate on $1 million home as opposed to maybe an inflation rate on property taxes or insurance, or there's small little expenses inside of that. And they're significant and they're meaningful. Don't get me wrong. And maybe they are faster than wage growth, but the reality is that you're actually getting inflation at the same time on something much bigger and much more expensive. If you take a look at why all of us here, Matt and Robbie and Steve and me and Ross have done extremely well, it's not because we were so incredibly brilliant. It's actually because I bought properties. My very first property, 182 units, I bought for $9.7 million. I still own it. And why is that? Because I was so remarkably brilliant back then. I was just as green as anybody else, but I still own it. And inflation has done its thing and the tenants have paid it off. So, and yes, my expenses are higher. My property taxes, insurance, and labor and all that stuff is so much higher than it was, since I've owned it. And I think this is a long game, and the government's going to continue to do their thing from an inflation standpoint. Yet you could buy something and the price could go down, and that would be considered deflationary for sure. But that's part of, the strategy of when to buy in a market. And there's a bigger picture there too. Like the picture would be, are there more people buying single family, and are they still in your residence? Well, in that particular time, your values, it's going to be hard to manage a property, and you could have a value that's trending down. But right now, we have single family home prices at high numbers, and we have interest rates at high numbers, and so we have more people being pushed into the rental side of the market. So I personally am not worried at all about a deflationary time for multifamily over the long haul. We already had the correction for value when interest rates run up. So that's already happened. So I don't know if we're at the bottom, it'll keep going down, or maybe it's starting to trend up. But again, if it cash flows today, like Matt's talking about, like that mobile home park, or the stuff they're working on, the multifamily stuff, the stuff that I've invested with you guys, for example, has done extremely well. We bought, well, I guess I've been in that stuff for about a year, maybe.
Almost. Yeah.
I actually have 3 checks on my desk right now. I've never cashed them. They're sitting there. I was waiting for you to ask me, like, when are you going to cash those checks? But the reality is, this is a long game we're playing here. So in the long game, if you're playing the long game, inflation is your friend.
So, Matt, you've been a part of our collective inner circle, and you and your partners, Robbie and Steve, were some of our founding members. And for those that don't know what the collective inner circle is it's a group that Ken has that is, Ken, why don't you explain it?
Sure. Well, actually, Matt, why don't you tell me what's been your experience? Come on, I mean, here's the thing. Like as you know, a lot of people might know, I get asked to do these mentoring, coaching stuff, and it's really hard to formalize that and spend time on that. And I'd rather buy real estate. And so we meet 4 times a year as a group. And people that want to be a part of that are a part of that. And we sit around and we strategize. We bring our numbers. We're transparent. And we're just really trying to figure stuff out together as a group. I don't know, Matt. What do you think? How's your experience been?
Well, I'm still in. I'm still in. We're 4.5. What is it? 4.5 years at this point that we've been doing it. I think it's been interesting. I'm really I'm glad to be a member of it. I'm glad that you guys delivered on what you said you were going to do in the first place. We were literally at Rebel Capitalist Live, and it was pretty obvious you guys had just founded this thing. I didn't find out till later that it was like 2 weeks ago, like 2 weeks before. You were like, you know what? Let's do a mastermind and hey, somebody buy a domain name and see what happens, right? It was interesting. It was interesting, but we took a leap of faith with you because it was like, if hypothetically speaking, this is what they're proposing, where we actually would get access to yourself and Jason and George at the time, and now Robert Helms as well, from the real estate guys. Pardon me. if we're really getting that, if we're really getting that access, then it's worth whatever the price of admission is. Like literally, I think being able to get to the point where I actually call you a friend has been one of the coolest things I've ever had to do, and so I've got to do, I should say. So we've traveled, we've gone to a couple countries now at this point too, to help the Bahamas and Mexico, and having my family there and getting to meet you as well, and getting to experience kind of the camaraderie that we created among the members has been fantastic. So,
yeah. And I remember, like, right after you joined, as expected, you brought your whole team out, including your CFO, to our company. I lifted the hood. You got to see what's in the engine. You ask a ton of questions. You still ask a ton of questions. And obviously you're just trying to grow your business, right?
Yeah, it's been fantastic. I think I've told you this before, but the opener that you gave, the first event, you gave a tour of your office to the entire collective. And we got to speak to your CFO and to your CMO and get to ask them any question we wanted to, right? And for me, I told them, like, hey, if that was the entire event, like there's no other 3 events this year, if there's no, we don't see each other again until next year, I've got my money's worth. I can get back on the plane right now and head back to Ohio. That was fantastic. And then you were even more generous where we came out on our own at another, as you mentioned, another time, brought our team, start just asking you questions and getting some time with your top staff. And it's been really informative for us as we've grown over the last 4.5 years, right? We've had some pretty phenomenal growth. We picked our executive team out, and a lot of that was influenced by our time with you. So I really can't put a real number on it. I'm glad you keep the price where it is. I'm just going to say that, but
yeah, no, we will.
It could be higher.
We will. But we also got on, remember, we pulled our organization charts out. You pulled yours out. I pulled mine out.
Yeah.
We went through every single person, how it flows, how it works up. Like that is kind of the point of a mastermind. Yeah. And by the way, we do that with a lot of our members, and the ones that want that information. Of course, it's all part of it, but it's been, and of course, I think, as you know, Matt, we've come a long way from organizing it and figuring it out and how to make it better for everyone.
Yeah. Well, it's like a new
first time. It was a little dicey the first time, but
I have to admit, I would say that first year we were trying to figure things out, but now I think we've got a director. Things are flowing quite a bit better.
No, I mean, like I said, we're still members. We're happy to be members. We enjoy it. And even in our busy schedules, I mean, we've all got things going on. We're making time for those 4 days. We're doing our very best to make time for those 4 times a year. And it helps that I've got a couple partners because we sometimes rotate a little bit. We got things going on with the kids and whatnot. But it's more importantly than that, more importantly than the 4 get-togethers, really is just the access that you've given. Can't commend you enough on how amazing that's been to be able to be like, hey, I'll text you a question and you might take a little time, or sometimes you're like right on it. It's interesting. It's probably going through your VA or something.
Don't worry, Matt. I get the same treatment.
Oh, really?
Yeah. Sometimes he's right back. Other times I'm like, I see your red receipt. Why aren't you answering? But see, unlike you just patiently wait, where he gets like 8 follow-up texts from me until he sees it.
Yeah, I think you've got a little bit more standing your buggy.
I don't know, man. I feel like I'm walking into a trap. Then I just keep my mouth shut at this point.
Smart man.
Matt, what is one specific decision that you made differently because of the inner circle?
We implemented EOS. In our company, and EOS is the Entrepreneur Operating System, and I'll give a super short summary of why that feel like it was so impactful. As an entrepreneur, your business is going to grow, and it's normally very reactionary, right? Like something goes wrong, then I need to go this way to avoid that danger or go towards that opportunity, and it kind of grows in this organic, not disciplined way. Right. It's just a natural thing that happens in almost every single company. And the way I describe it, I got the perfect analogy from my wife when she started gardening a few years ago. So she was explaining to me about her tomatoes one time. And she was like, so the tomato plants really resilient, right? You could literally just basically throw some tomato seeds on the ground and you'll have a tomato plant. Like you don't really have to do much to it. And it'll produce. But what happens is if you put in a lattice work, which is a structure for it to grow on, it produces 10 times as much as if you just laid it on the ground, right? That's what that structure, that lattice work is how I describe EOS. It's the system that your business grows on. And it really, really just increases efficiency. Everything from the conversations, the terminology, the lexicon that you're using to communicate things changes all of that. And it's been fantastic. Ken had recommended it to us the first day we were there, right? Like the first day we met, he's like, you need to hear about EOS. And we were so busy doing every single function in our business at that time that we're like, we can't even take on learning about EOS. That's how busy we are right now. So we're happy we got the 2 days here in town and now get back to the grind. But short version, 3 years later, we're like, maybe we should try this EOS thing. And the minute we did it, it's been fantastic. So that's one of the bigger things that Ken has brought to the table, as well as the inner circle.
So I know that, part of the inner circle is learning about business. And then the other part is making relationships with people that, are in the same situation with you. So you can celebrate wins together, but you can also talk about, struggles that maybe other people can't really relate to together. So what do you think has been more valuable to you, the relationships or the business? And you can be honest.
Honestly, I think I'm going to go, you said A or B, I'm going to go with C. Because I feel like it's hard to be like one is more important than the other to me. I think we've built some really cool relationships that are outside, where we're outside of the collective communicating. And like one of the members, I won't name any members, but one of the members' sons is like best friends with my son, even though they hardly ever see each other. They're literally, my now 10-year-old and his 9-year-old, when they met in the Bahamas, they literally just got together like they've been friends their whole lives and been running all around, right? So those two are still friends, and then we still communicate. We're planning how to get together and get them together, right? So there's just things to it that you really can't put a value on. Like, what is that worth? Like that having that different experience or having that new friend in his life and seeing how much fun they're having together and seeing us being I'm friends with his dad, obviously, right? So I would say the relationships are amazing. We got people who now are investors with us that we didn't go there looking for investors, but you get to know each other. You build a level of trust, and we got people who are investors with us, people that we invest with. I think it's phenomenal all the way around.
Yeah. I'll tell you, I just had dinner with Damien last week.
Oh, Damien.
Oh yeah.
How's he doing?
He's the greatest, man. He's like, hey, after all this shakedown, he goes, you and the guys from Ohio, that's what he said. He goes, thank you guys, like for, running your businesses the way that you run them. And I think, again, going back to that question you had earlier, the jockey's important, right? Matt, what's the best way people can reach you? Because I'm invested with you guys. You guys got some really cool stuff going on. I think you're one of the premier companies, certainly.
Stop.
So
it.
What's the best way?
Stop you.
Come on.
No, but really, honestly, I would just send people to our website. Like I'm like terrible on social media. Like I like random pictures once in a while. But if you wanted to go check out what we're doing, it's vrec.com. And if you want to email me directly, it's Matt@vrec. Matt with 2 T's. vrec.com.
Yep. vrec.com.
Yeah. Yep. So that's the company. Venture Real Estate Company is our company.
Awesome. Thanks, Matt, so much for being on.
You're the best. Hey, big hugs to the fam, man. We'll see you in November, hopefully at the Gold Cup.
Yeah, and you and your wife have to come out to Scottsdale. Come hang out.
I'm game. I love
Let's go. Let's go.
Love you guys too. Appreciate you guys.
Yeah.
God bless.
All right, you too, Matt. Cheers.